Chapter 3, Cost Volume Profit Analysis, Part 2. Now we've covered the objectives, some of the features of CVP, and we looked at break even and the output level needed to achieve a target operating income before. Now we're going to look at how cost volume profit affects tax, how managers use it to make decisions, a little bit about sensitivity analysis, and then how to plan variable and fixed costs. You know, these are just briefly introduced like in the textual part, but we really have to look at problems for this to make sense, okay? So here's cost volume profit and taxes. We've been assuming that the non-operating revenues and non-operating expenses are zero. For purposes of this income tax illustration, we'll continue that assumption, and we've been ignoring the effect of income taxes thus far, but now we want to recognize that in many companies, managers' income targets are expressed in terms of net income rather than operating income. Okay, so the key is to convert target net income into the corresponding target operating income, which is what we use in our CVP formula. So the conversion formula on the slide is net income divided by 1 minus the tax rate. Okay, that would give us the operating income we'd need. The CVP equation keeps going using operating income, but we'll use this formula to get operating income value when provided with net income. So if you take your net income divided by 1 minus the tax rate, okay, then you'll get operating income. Okay, it's a little bit backwards. And here's just a proof of it. This is what it's doing just for your head, that if that's your net income, taxes would be 20%. There's after-tax net income. Now, if I take operating income and divide it by, or multiply it times 0.8, I get after-tax income of $8,000. What if we take, what were we supposed to do? Take operating income? No, take net income and divide it by 1 minus the tax rate. I'll just put it in here. 1 minus the tax rate, which is 80%. Okay, which would both help you. Our net income is 8,000. Oops. Divided by 0.8. 1 minus, yeah, because it's 20% tax rate. Equals 10,000. Okay, do you see what I mean? Just look at this for a second. So net income divided by 1 minus the tax rate, the 0.8, would give us income from operations. Okay, that's operating income. Okay. So say 30,000 divided by 65% with a tax rate of 35% gives us 46,154. And to check, go through the formula for break even plus target profit. So 66,154 divided by 250 gives us 265 units. Okay, we just have a little bit of rounding. Now remember Tiny, the guy with the cabinets, he wants to sell 100 cabinets. And what if Tiny spent $5,000 on advertising and thought it would increase his sales by 10%? Should he do it? So we use cost volume profit analysis. We take our units sold and increase it to with the advertising would be 110. Our revenues would be 66,000. Okay, variable costs 30, it would increase also. Now our fixed costs are increasing by 5,000. Okay, fixed costs went from 20 to 25,000. So operating income with these assumptions would actually decrease to 2,500. So CVP can be a powerful tool when put to work with various decisions that have to be made. Instead of guessing whether the 5,000 spent on advertising will improve operating income, you can make some assumptions and then make some decisions based on this information. Now in this slide, we change one of our assumptions and then do the same analysis. This ability to quickly change the assumptions and rework the formula shows managers how, like an entire array of possibilities as they decide how to proceed. Okay, maybe he'd be better off if he didn't advertise. Okay, what if I told you that a more detailed analysis indicated that tiny sales would increase by 25% instead of 10%? Should he do it? Okay, a quick way to do it, if sales increase by 25%, then that is going up by 25 units times unit contribution margin of 250 gives you 6250. Okay, so that's $1,250 greater than the $5,000 that Tiny would have to spend. So in this case, he'd be better off spending the money on the advertising. Okay, but the key thing here is whether or not what advertising increases by. All right, is it 5% or is it 10% or is it 25%? That's a pretty big assumption. So CVP can be used in a wide variety of decision-making processes. It works well if you're thinking about decreasing prices. If you decrease prices, you'd expect more unit sales. So if you use the combination of a lower price with higher unit sales would improve operating income, you would use CVP analysis. But it all includes risk. Okay, we're using CVP to evaluate how operating income change, but you can't be certain if the estimates will occur. The estimates are the big question, okay? And you're usually depending on other pieces of the organization for those assumptions. Usually it's coming from marketing or sales. So you use a spreadsheet, and put your assumptions in there and see how sensitive the results are to changes, okay? And sensitivity analysis, since CVP is used in many decisions, okay, like whether to decide whether or not to advertise, whether or not to increase or decrease prices, sensitivity analysis is sort of a what-if technique to examine how an outcome will change if the original predicted data are not achieved or if an underlying assumption changes, okay? And this type of analysis can answer, for example, what will operating income be if the quantity of units sold decreases 5% from the original prediction? All right, so it's all this type of changes here. So here we've got a company that determines that an ad campaign costing $15,000 is expected to increase sales by 25%. Should they go forward? Okay, it's similar to what we just did, the prior exercise, but you've got to do this kind of analysis. And then margin of safety. It's an aspect of sensitivity analysis that answers the specific question, if budgeted revenues are currently above break-even, how far can they fall before we hit the break-even point? All right, that's the question. How far can they fall before we start to lose money? So the margin of safety, it's actually a ratio that removes the size of the firm from the output. It's budgeted sales minus break-even sales. So the MOS ratio removes the firm size, and what we do is we take the margin of safety divided by budgeted sales gives you your margin of safety ratio. Okay, so let's see how that would work. We'll have to, you know what, I thought I had a problem here, but I don't. We'll look at it in a problem later on. So cost structure is simply the relationship of fixed costs and variable costs to total cost. And managers make strategic decisions that affect the structure, and that information is, of course, used in CVP analysis that we've just been talking about. Okay, the risk-return trade-off across alternative cost structures can be measured as operating leverage. And it's actually a really good concept. The formula to calculate operating leverage is the contribution margin, okay, divided by operating income. Note that the difference between these two values is our fixed cost. Okay, contribution margin divided by operating income. So fixed cost is what's missing in there. And fixed cost is a reflection of like how much we have invested in fixed assets. Okay, organizations with a high proportion of fixed costs in their cost structure are said to have high leverage. So in this type of cost structure, small decreases in sales result in large decreases in operating income, and vice versa. Okay, a small increase in sales can result in a large increase in operating income. And once that fixed cost is covered, then it's all profit. Okay, and it's helpful at this point to remember what fixed costs are and how they behave. They are costs that do not change in the short run with the level of sales. The costs will exist regardless of the sales level within the relevant range. Okay? So operating leverage is more than just an indication of the cost structure. It can also be used to estimate the change in operating income that will result from a change of sales. And all you do is take the operating leverage times the percentage change in sales. And the result is the change in operating income. And they've got an example here. If sales increase 50% and operating leverage is 1.67, you could take 50% times 1.67 and expect income to increase by 83.5%. Okay, it's easier to have some numbers to fool around with this and watch it work. So far we've been contemplating a business with one product and therefore one contribution margin. Where most often, though, companies have multiple products with varying contribution margins. And we can still use CVP analysis, but instead of using the contribution margin for one product, we'll use an average contribution margin. And the average contribution margin is calculated based on a defined product mix. So this is one of those assumptions. We assume that the ratio of products stays the same. So in other words, contribution margin is determined based on a specific relationship of sales of product 1 to total sales, product 2, etc. And if that relationship of sales changes, then our average will change also. Okay, so what we're really doing here is assuming a constant mix. So it's not just for merchandising and manufacturing companies, it's more prevalent there, but it's certainly useful for service and nonprofits as well. And the challenge is to focus on a measure of output, which is generally going to be different from the measure of units sold that we've been dealing with so far. Okay? All right. And that's the hard part, is the measure of output. For example, a service company might measure how many persons they assist, or an airline might for sure looks at passenger miles flown. It's a major indicator for them. Okay, and what might a hotel use? A hotel would probably use guests. A restaurant would use number of guests. Okay, and the gross margin is obtained from subtracting all manufacturing costs from revenues, right? Those manufacturing costs include fixed as well as variable, whereas contribution margin is obtained by subtracting all variable costs, both manufacturing and non-manufacturing, from revenues. In a period when there's no change in inventory, can't imagine how that happens, the operating income will not differ between the two calculations. However, if inventory increases or decreases, the fixed manufacturing costs will be absorbed into inventory, causing a higher operating income. Okay? And that's important to understand. Both formats are important for their particular purposes, and one shouldn't be really dismissed in favor of the other. Okay, it depends on what your purpose is. And finally, from this slide, we can see the gross margin operating income is higher than contribution margin operating income by 1,500. Okay, this is an example of Tiny's cabinets again. We've got fixed costs of $20,000. They produced 100 and sold 90, so 10 went into inventory, and the 10 that went into inventory have a little hunk of fixed cost attached to them. Okay, So that's why the operating income for absorption costing would be greater than that under a contribution margin. So let's do some problems in each one of these areas and practice all these things.